Hi, friends. It's Monday, April 7th, 2025. I wanted to give you an update on how the markets are reacting after 2 days of market volatility based upon President Trump's tariffs. Now, during this video, if you see me wincing at all, it's not because I'm checking the market updates. It's because yesterday I went out on Irondequoit Bay in 34-degree weather with north winds about 10 to 12 miles per hour to go catch some fish. I did. I was successful, but when I came home, I also stood over a table to fillet about 25 fish or so and really threw out my back. So during this video today, if you do see me wince, it's because my back decided to act up and it got me. Also, this rosy complexion isn't from anything but windburn. So let's get to the video. I wanted to use a tool called Y Charts. Now, Y Charts is a software program that I use to analyze all different types of investment options for my clients. And it gives me a great amount of detail on how investments perform in good markets and in bad markets. But today, I'm not going to get into any specific investment. I'm mostly going to talk about what we're seeing overall in the S&P 500. The reason I'm going to look over the S&P 500 because it shows us the 500 biggest companies in the US at any given time. And it's a good indicator about how the US markets and the US economy are performing given any set of circumstances. As we go through these scenarios and look back over time, what caused market drops and how the markets rebounded, please keep in mind past performance does not guarantee any future results. So, taking a look at this chart, what we have here is three major indices. We have the S&P, which is purple. We have the Dow Jones and the Nasdaq, and this is showing year to date. So let's not focus on year to date quite yet. What we'll do is we'll take out the Dow and the Nasdaq. Okay. So as you can see here, this is where we started. That's our base 0 for YTD. The market peaked about February 18th, 2025. That's when the news about tariffs started to kick in. And as you can see here, here is April 2nd, April 3rd, and today. Now, is this volatility unprecedented? I would probably say no. And for those of you that have been working with me for some time, this isn't the first time we've seen something like this. This might be the first time that we would consider it self inflicted a little bit, but otherwise, this volatility isn't truly unheard of. So let's take a look back at the S&P 500 for a year. So if we take a look back to a year, this is going back to April 5th, 2024. Here's our today. Year to date or year over year, we're down about 4%. What the tariffs did in the last few days is we wiped out pretty much all of this growth in 2024 in the beginning of 2025. Now, if you've studied any of the market news recently, you would know that a lot of the growth we saw in 2024 was from what we call the Mag 7. Those are the 7 companies, a few of which are like Tesla, Alphabet, which is Google, NVIDIA. Those 7 companies were driving almost all of this market growth that we've seen. To the point where some index funds have started giving disclosure in their prospectuses saying, hey, if you're buying the S&P 500, we're almost a concentrated fund right now. There's really only 7 companies that are driving this growth that we've seen. Hasn't always been the case, but for all of 2024, that was a lot of the case. So let's go back 3 years. Okay. 3 years ago, we hit April 8th, 2022. If anybody can remember how 2022 went, you can see right here. It was a down year in both the stock and the bond market. Why was that? That was mainly due to rising interest rates. Interest rates went essentially from 0 to 5 pretty quick. And what that did is tighten up the money supply, made credit a lot more expensive, and this is how the stock market reacted. But if you handed me a good chunk of change on April 8th, 2022. You had to sit there with me and watch it go down pretty much all of 2022. But right now, that investment, even after the volatility that we've seen, is up about 11%. Now, granted, it felt a lot better up at 36%, but still, long term perspective, we're doing well. We go out 5 years. Interesting. What was 5 years ago? Well, in this scenario, you're looking at the very bottom of the COVID 2020 lockdown drop, where the markets reacted to the global shutdown of economies. So here, it's kind of skewed because essentially April was the bottom of that drop. But over the last 5 years, the return in the S&P 500, even considering the fluctuations we've seen in the market recently, 87%. That's pretty good over any 5 year span. And if we take a look at the 10 year, you're starting in the April 20th, 2015. The interesting thing about 2015 beginning of 2016 is we had an energy crisis. Markets took a dive, if you can look right here. But since then, we've got the 2020 drop. Excuse me. Since then, we've got the end of 2018 drop there. We got the COVID drop there. And here we go. We got January 4th. That's our 2022 interest rate spike. We got the drop there. And here we are, end of last year up to February of this year. Still, the 10-year return on the S&P 500, even after these tariffs drop, even after the drop from the tariffs, we're still looking at 139% return. Or if you take a 10-year average, 13%. Really, in my previous video, I talked about the idea of when in doubt, zoom out. And I really believe that. Now, it doesn't help mitigate the feeling of loss that we're experiencing right now in the volatility from the tariff drops. But to put it in some perspective, in the last 10 years, how many different crises have we been through? We've been through the energy crisis, the very end of 2018, the 2020 COVID drop, and the interest rate spike that we saw pretty much all of 2022. So while these tariffs do hurt, while they are a bit self-inflicted right now, it isn't unheard of. And if you really want to zoom out, we can go the max. We go all the way back to 1950 or so. And we can see the growth, 30,000% return in the S&P 500. Now I want to take a look at a few scenarios of if you were to become a client right before any type of bad news and major market drops. So first thing we'll go back to is August 17th, 2015, the day after my 35th birthday. Monday, you say, "Hey, Christian, happy birthday. I really like you. Here's a good chunk of money. I want you to invest in the stock market." And I say, "Thank you for your trust. I really look forward to working with you for years. I really appreciate it." Well, immediately after that transaction, what we find out that the news comes out that China's economy is slowing down. They decided to devalue their currency. On top of that, oil prices plummeted then. And the Fed had their first rate hike since 2006. All this happens within a day or two, your account's automatically down 10%, just like that. And that volatility carried in to 2016 too. So, what happened in 2016 that got us out of those two major news events and led us into decent growth up until 2018? Well, what happened was oil prices bounced back. The Fed turned dovish, meaning they weren't going to look to raise rates as much. They stopped that, so to speak, potentially looking to lower them. China added stimulus to their economy, got their economy going. And corporate earnings all around bounce back. Companies start to make money, that drives the stock market up. So the next scenario we'll take a look at is if you referred me to a friend and that friend said, "Hey, Christian, you know what? Let's invest together. I really like what you did for my other friend. Let's see what you can do for me." And that happened at the beginning of 2018. So if we go to January of 2018, we'll go on the second, which would be a trading day. What happens in 2018? We have a pretty decent year here, pretty growth. And then December 2018. I don't know how many of you remember December 2018, but it was considered the worst December the markets have had since the Great Depression. You hear that news, what do you expect? What are you thinking? How are you feeling? So what caused the 2018 drop? Well, in 2018, Feds weren't dovish anymore. They raised rates 4 times in 2018. Get this. There was a trade war between the United States and China. China escalated their tariffs on us. What did that do? That hurt the tech sector and the industrial sector. Oil prices once again dropped. That caused obviously the energy sector to lose value. And in December of 2018, I don't know if you guys remember this. A lot of times you heard the words algorithm, volatility trading, stop loss triggers, all that now automated trading caused a major market sell off in December and accelerated that downturn. So once again, your friend comes to me, you and your friend say, "Man, that news is bad. What's going to happen? What's going on?" Well, what happens is 2019, the Fed pivoted. They called it the pause. They stopped raising rates. Trade tensions were eased between the US and China. Sounds like a good idea to me. Corporate earnings bounce back. Companies make money. Stock market goes up. Banks, not only in the US, but globally, started to stimulate their economies. That never hurts. So essentially, what we experienced in 2019 was a mirror image or the exact opposite of what caused that great downturn in 2018. Now, overall, that return since they started in the beginning of 2018, given that December downturn, the 2020 COVID lockdown drop, and the 2022 interest rate hike that we've seen here, that client's still up 87% in the S&P 500, even given the recent market volatility since the beginning of 2018. Thanks for watching and going through these scenarios with me. I'd like to conclude with the thought that stays in my mind the most when I'm working with my clients. There's studies that show that losses hurt twice as much, or you feel them twice as badly as gains give you pleasure. So it doesn't matter how well the markets are doing, you're always going to feel those losses twice as hard as you would ever feel any gains you make. So in future videos, we're going to talk about strategies that I implement with my clients to help mitigate those losses, to try to avoid those feelings. I hope from this exercise you can see that volatility in the market essentially is the price that we pay for some really good gains over the long term. Now, I will be honest, there's a certain point in your life where you start to look at your balance sheet and say, I kind of like that number, and I don't really want to go through that ride to get there that I went through the last 20, maybe 30 years. Very few people like to have that ride in the markets their entire lives. I know a few. So keep in mind all the volatility that we've heard from the tariffs, very scary, very unnerving. Ultimately, is it something that we've never seen before? Not really. In the next few videos I'll be putting out and discussing volatility, we'll go over the strategies that I use with my clients to help mitigate some of those losses and help smooth out that ride for the long term. Thanks for watching. If you'd like to connect, feel free to use the link down below to find a time that works best for you. I wish you and your family all the best and take care.